So this is almost end of the model tax conventions, and here we are going to discuss some procedural aspect. So why do we need procedural aspect? Two major discussion we are going to discuss here. One is mutual agreement procedure and exchange of information. So please understand these two terminologies, my dear friend. We have discussed so many instances where despite of having double taxation agreement, there is a still possibility that income may get taxed in the resident states as well as source states. Yes, and whenever it get taxed in the resident states and source state, usually DTAA should provide for the relief. What relief mechanism has to be adopted? Either exemption method or tax credit method. But still there are certain instances where none of this method may be prescribed, and due to economical double taxation, please understand, it is not for theoretical or jurisdictional double taxation. Due to economical double taxation, the countries has to sit and mutually decide on certain terminologies that whether the income is taxable in the source state or contracting state. If yes, then at what rate it should be taxable in the source state, and then at what rate it should be taxable in the resident state. So there are so many points in whole DTAA mechanism that has to be discussed and agreed upon by mutual discussion. So the procedure of mutual discussion is written in article 25 that we are going to discuss, and definitely one more article, that is the last article that we have to discuss so far as syllabus is concerned, that is importance of exchange of information clause. Special provisions, article 25 mutual agreement procedure, also known as MAP, very famous, where a taxpayer, please understand this is from taxpayer's perspective, because obviously taxpayer is a person who is getting aggrieved because he has to pay tax in two countries due to lack of DTAA, where taxpayer believe that the treatment accorded by either or both of the contracting state is not in accordance with the provision of the tax treaty. The article provides for dispute resolution through bilateral negotiation between competent authorities of both the state. So who will come? So India will send a competent authority, a foreign country will also send a competent authority. They will sit and they will mutually negotiate to come up with the best possible solution. So request of MAP, who can request in MAP? Now OECD model and United Nations model is having some differentiate mechanism. So let us discuss that. In OECD model, the request will be initiated by the taxpayer. Please understand, the request is always initiated by the taxpayer. May make a request either to the contracting state. He can make request to the resident state or source state, but taxpayer has to make a request. In United Nations model convention, alternative A, a taxpayer has to approach to the resident state or the country of his nationality. That is the first option. So if it is the Indian citizen, he should apply to the CBDT or Indian authorities. Alternative B, he should make a reference for arbitration. Arbitration means kind of they will appoint a third party, and then third party will give the solution, isn't it? When these competent authorities are not able to give him the solution, he may request for an arbitration. Okay, let us bring an expert into this matter and let's listen to the expert, what expert has to say. Okay. Reference to an arbitration process as a part of MAP. The decision arrived at through process is binding unless the person directly affected does not accept it. Obviously, the arbitrator, whatever arbitrator decision is given by arbitrator will be applicable on the contracting states. But if the person assessee, the decision is given against the assessee, then he can challenge. At the same time, please understand, in OECD model and United Nations model, the timing difference is also there. It stipulates that the time limit of 2 years from the date when all the information required by the competent authorities in order to address the case need to be provided. So please understand here, if they are not able to provide the solution within 2 years, then the matter will go to the arbitrator. And in the United Nations model, if they are not able to provide the solution within 3 years, so timing difference is also there, which may be targeted in MCQs. So arbitration may be initiated if the competent authorities are unable to reach at an agreement on the case within 3 years from the presentation of that particular case. Okay, in alternative B, it will happen, obviously. Now, who can request for arbitration? Arbitration must be requested by person who has initiated it. In OECD model also we are having the concept of arbitration, and obviously arbitration will be demanded by the taxpayer. Okay. In United Nations model, please understand, arbitration must be requested by competent authorities, not by the taxpayer. Here competent authorities will call for arbitration of one of the contracting state. Once such request is made, the taxpayer will be notified. Here taxpayer will be notified in, because they are this OECD model, it is developed nation, matured people are there, they can handle the cases. In United Nation model, it is a developing nation, so government is taking responsibility for arbitration. So is it binding? Definitely binding, even if it is against the government. So please understand, departure is not possible, or at least there are no provisions in OECD model to depart from the opinion given by the arbitrator. Please understand, no specific provision of departure from the arbitration. But United Nation model has a provision, but that provision is a time bound, that relief is a time bound, it is given to the government. The competent authorities may deviate themselves from the arbitration decision if they agree to do so, but that is time bound within 6 months after the decision has been communicated to them. So once they know the decision and if they are not agree with the decision, within 6 months from the date of decision, they can depart and they can bring the new solution to the problem. Next one is exchange of information. Very important clause of every DTAA. If they don't share the exchange of information, if the country doesn't share the information with us, then we have right, every country have right to declare that particular country as notified jurisdictional area. And you know the consequence of notified jurisdictional area are worst. Okay, nobody would like to do business with the country which is notified jurisdictional area due to the high consequences, isn't it? So purpose of Article 26, in order to complete the tax cases, please understand, whenever tax is initiated, whenever scrutiny is initiated, inquiry is initiated in India, assessment procedure has begun. Then to complete the assessment, India may need the information from the foreign country, and foreign country should not deny for sharing that particular information. In order to complete the tax cases, a country may require certain information which may be available with a treaty partner. Article 26 provide for the info that may be exchanged, the manner in which such request has to be made. Importance of Article 26, facilitate effective exchange of information between the contracting states, curtails the cross-border tax evasion and avoidance. You know that many people used to put money in Switzerland, and now India had proposed Switzerland to share the information of all the account holder that they are having so far as Indians are concerned, and they denied in the round 1. Then India gave them warning, if you deny, then we will declare you as a notified jurisdictional area, and that will be very difficult time for you. So they agree to share the information, and now people are not saving black money like old days in Swiss banks. Okay, curtail the capital flights, that is often that is often accomplished through the tax evasion and avoidance. This is particularly relevant in the perspective of developing countries. So obviously this is very important, because evasion happens usually in developing countries, because you know the system is not perfect, the government is not stabilized, so there are a lot of loopholes in the system that can be explored. Similar provisions are contained in OECD and United Nations, so major differences are not there, common provisions are there. A contracting state cannot be expected to provide confidential financial information to other contracting state unless, so obviously if it is the confidential information, you cannot just ask, any random AO cannot ask. So if there is an authorized person, that authorized person, maybe finance ministry kind of, you know, the higher authority has to ask for a confidential information, unless it has confidence that the information will not be disclosed to the unauthorized person. So with a lot of caution, they may say the confidential information. A contracting state can avoid the exchange of information obligation by showing that the information pertains to communication between the attorney and his client, which is protected from disclosure under the domestic tax law. If domestic tax law protect that particular information by showing that legal clause, they may avoid sharing the information. So this is one of the relief given to them. Obviously then government of India will put the case, and they will share at a court level, like their Supreme Court can share the data with our Supreme Court without sharing the data with common people. The most important para is the last para, lack of interest. If India is demanding information from foreign countries, say for example Switzerland, now Switzerland cannot say I am not interested into sharing the information, because I don't see any benefit to my country if I share this information with you. Now we are saying no, we will share the Switzerland people data with you. They are saying we don't care about Switzerland data, we don't have interest in their data. So lack of interest, please understand, lack of interest or lack of use in such information cannot, however, form the basis, please understand, for the contracting state not to cooperate with exchange of information obligation. So you must exchange information even if you are not interested to share the information or you are not going to get any benefit out of that. Thank you.